You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Once we have a monthly close above 2,100 in gold futures, that will signify a breakout. And that's what momentum players, big money traders, everybody's looking at. That's that number. The 2000's been resistance for 12 years now. I'm sure your audience is aware of the cup and handle pattern on the long-term chart. And there's also, it's breaking out of a cup and handle pattern within the handle of that chart on a weekly basis. And we've had the miners and silver leading the whole time. So, everything's in our favor here. The wind's at our back.
Welcome back to Mining Stock Education. I am your host, Bill Powers, chatting today with my friend David Erfle from JuniorMinerJunkiewithAY.com. David, welcome back onto the show. And gold is over $2,000 an ounce. It hasn't penetrated that $2,089 high yet, but we've had some significant closes. What's your current commentary on the gold action, please?
Always great to see you, Bill. Thanks again for having me on. Yeah, it's interesting. As soon as the Fed minutes came out and they finally admitted that, we're probably going to go into a recession after everything that we're doing here. The gold price ran up to 2063 overnight. And that's like $26 from the all-time high of 2089. But yeah, we had two consecutive weekly closes above $2,000 in gold futures. We're trying to build a floor here at $2,000 an ounce in the futures price. And once we have a monthly close above 2,100 in gold futures, that will signify a breakout. And that's what momentum players, big money traders, everybody's looking at. That's that number. The 2000's been resistance for 12 years now. I'm sure your audience is aware of the cup and handle pattern on the long-term chart. And there's also, it's breaking out of a cup and handle pattern within the handle of that chart on a weekly basis. And we've had the miners and silver leading the whole time. So, everything's in our favor here. The wind's at our back. The gold price, it became, short-term overbought. So it's working off that short-term overboughtness by consolidating above $2,000. I think as long as it consolidates above 1925, 1950, I think the momentum is on our side, but the uptrend support and 18-week moving average support is at 1900. So I wouldn't be surprised to see it come down to 1900 first. That wouldn't shock me, because whenever you have a major resistance line, multi-year resistance line, it runs up to test that multi-year resistance at least 3 times, and then the 4th time is the charm, is when it breaks out. So wouldn't be surprised to see it come back to 1900 first.
To anecdotally illustrate that point about how when it reaches resistance, I see comments on the YouTube channel, and one came in this week to where it says, junior miners were the worst decisions I've made in the last 2 to 3 years. I can't wait till I get back to my entry point so I can sell these suckers and never have anything to do with them again. And that's kind of like the resistance, right?
Yeah, I know. It's incredible. It's the junior sector, it always underperforms on the downside, and usually massively. Generalist investors left this sector en masse in 2013 when gold lost $15.50 an ounce, and they've never returned. And we had massive capitulation begin last year at this time in this sector, and that's when everybody got out. That was holding losers. This is it. I'm done. So we had a major bottom as gold stocks. If you've heard me say numerous times, gold stocks have this 7-year cycle. They have major bottoms every 7 years, and we had that major bottom in September of last year, and everybody sold into that bottom. So. But what's interesting to me, very interesting right now, is I'm having deja vu, because when I first got into this, when I first discovered this sector in the early 2000s, after I'd lost half my money getting into the tech bubble late, I watched all my friends make all this money. I thought I could do that. They don't know what they're doing. They're making money, and quickly lost half my money in less than a year. But it was the best thing that ever happened to me, because it made me realize that, hey, if I'm going to try to make money in the stock market, I better learn to know what I'm doing. And it led me to the gold sector, because the gold sector was the only thing going up while everything was going down after the tech bubble burst. And that was the end of that, and a post-bubble contraction. And what was also happening at that time, started to happen at that time, was gold began to outperform the S&P 500. And strangely enough, going into 2005, I discovered the sector in 2003, and I'd done all this research, and I'd gotten fascinated with the sector. And it was forming a cup and handle pattern like it's forming right now, a 12-year cup and handle pattern below $500 an ounce. So I was watching that, and I was also watching the S&P 500, the gold to S&P 500 ratio, because I did all this research, and I found that back in the 70s, when the gold price got over half the value of the S&P 500, that's when the gold price really started to move, and especially the juniors and the gold stocks really started to move. So that's when I decided to sell my house and put everything into juniors when the gold price started to go above that 50% threshold. And we're on the verge right now. So we're having two major things in our favor right now: that cup and handle breakout on the long-term chart. It's trying to break out now. And also the gold price is trying to get above that 50% threshold on the S&P 500. And the gold price now, as it's trying to stay above 2,000 for the past two weeks, the juniors have started to begin to outperform the miners again, because the juniors always massively outperform on the upside after massively underperforming on the downside. So that's starting to happen now also. So you have all these things that are lining up at the same time. And if once that cup and handle does break out on the long-term chart, the gold price will likely double within the next 2.5 years. And that's what happened after it finally got above 500. I watched my account triple, and I really didn't know what I was doing back then compared to what I know now. At the time, I thought, yeah, I'm this genius, and I'm making all this money. But the gold price went from $500 an ounce in late 2005 to $1,000 an ounce by late 2007. And then, it had that consolidation at 1,000 for about a year. And then once it finally, it tested 1,000 3 times. And once it finally got over 1,000, it nearly doubled again to 1925 by 2011. And anybody who was right early and sat tight with quality juniors made a lot of money, me included. So it changed my life. And I like I said, I have deja vu, because I see all that happening right now at the 2011.
Dave, with your stock picking service and what you share with your subscribers, you try to pick out quality junior miners that are cut above the rest. However, you can actually make more money sometimes on the juniors that are not as good if you time it right? So do you have any thoughts on playing this?
Well, that's what happened in 2011, right? Because the companies that went up, the companies that went up the most are the companies that just had multi-millions of ounces in the ground that were low-grade bulk tonnage. So if you're an expert, right, and you're getting in earlier, you're staying away from those. At the time, I wasn't an expert. So I looked at these companies. Wow, look they got these millions of ounces in the ground, and they're trading at pennies. I'm going to buy these companies and I turned out to be right, but I got lucky because I didn't know what I was doing. So it's really funny the way that happened. But, and also when the majors did that, they ruined this sector for the next decade, because they not only bought all these low-grade bulk tonnage ounces that needed higher gold prices did it with dilution, which is a double negative. So it killed the sector. That's why you see the GDX, the GDXJ underperforming the gold price massively for the past decade. So they've got a lot of catching up to do, because these majors are finally doing the right things now. They cleaned up their balance sheet. That they're concentrating on high margin projects, lowered their debt. They're paying dividends. They're doing everything they can to attract generalists again, who've been gone for the past decade. And once these generalists get back in, this is when this sector is really going to take off. And they're still not in yet, because look at the volumes. The volumes are still very low. I don't think that's going to happen until the market, I've been saying this for a long time, the market starts pricing in a $2,000 floor as opposed to a $2,000 ceiling.
Or we see M&A pick up, right? That was your other criteria.
Right, and we are seeing M&A pick up. Yes, we are seeing it, because that we need to have much more M&A needs to take place in this.
And one,
there's just not enough. There's just not enough checks to there's only a certain amount of checks that these capital market writers can write. So we need more.
One of them they're trying to write is for West Red Lake Gold Mines. They've inked an agreement with Sprott Resource Lending Corp and Pure Gold Mining to acquire all of Pure Gold Mining and that failed mine build. Any thoughts on this one, Dave?
Yeah, it kind of reminds me of what happened with Rubicon, right? In the same area in Red Lake. Rubicon tried to make a go of it. They skipped an important economic report to try to get into production early, and it sunk the company. It even suckered in Royal Gold. They gave them a bunch of money and lost out on the deal. So the Red Lake is interesting. Either you're a prince or a pauper if you're in Red Lake, because it started, one of the biggest gold companies in the world in Gold Corp with their mine there, and it's and you had Great Bear make a discovery and end up selling that company for over $1 billion an ounce in a bear market. But on the flip side of that, you've had two company ruiners in Rubicon and now Pure Gold. They've tried to make a go of it. So it's interesting there, like what happens.
In Rubicon, that deposit was then successful, at least thus far, with Battle North. They rebranded.
Right. Battle North is making that successful. Right.
Dave, what's your thoughts? When I've mentioned on the show in the past, like if you have a failed deposit and another group takes it over, rename, rebrand, fresh start. And some people have written in and said, no, that's covering up, the mess. And my perspective is I use Battle North as an example. Like Rubicon was a mess. I don't disagree with you.
That's right.
But if
it all depends on the people and of course the geology. And they just could have, they might just be reading it wrong. I mean, you've seen there's plenty of examples out there where companies, new management teams came in and turned something around. And there's also, examples of doing the opposite. A management team takes over a company that's sold by a major and they can't make a go of it. And they find out the reason why the major sold it. But the flip side of that, there's a company like K92 who bought a mine from Barrick and turned it into a major big profit moneymaker.
But I think a discovery was a big factor there too, right?
Right.
Yeah.
Exactly. A major discovery underneath a mine that was already there. Yeah. I mean, and that happens also. So you can't you can't look at something and say, well, just because this company didn't make it on this one doesn't mean a new company isn't going to make it on this different deposit or different mine or whatever. I mean, you have to sharpen your pencil and take a look, and that could create a major opportunity. And this could create a major opportunity for Westlake shareholders. Absolutely.
Dave, if a new listener is listening and they don't own any junior mining stocks yet, as we conclude here, what would be your final advice for them if they're looking for an entry point?
Well, this is a great time. You still got time to accumulate these things because, like I said, you're starting to see sector rotation. What's happening is, the majors and the mid tiers and the royalty plays, they've had these nice runs, right? And so people in the know in this sector, I mean, that's basically who's only in this sector now and trading these companies are, resource speculators. They're very intelligent and they understand that these companies move first. And then once they get overbought, you take your profits and you rotate them into the juniors that are still being ignored. And that's what's happening right now. You're starting to see these juniors pop one by one from these 4 to 6 month basing patterns. Some are going up, over double digits in a single day, even when the gold price is down $20, $25. like today, a few of my stocks are up on the day. The last 2 days, a few of my stocks were up on the day, even though the gold price was being hit for double digits. So, weakness is being bought here. As the gold price, is trying to create a floor at $2,000, and people in the know understand this, and they're starting to get into these juniors. Volume is picking up on the quality juniors, but there's still quite a few of them that haven't moved up yet, and the ones that haven't moved up yet are optionality plays. These companies that have multi-millions of ounces in the ground, and maybe they did their base case studies at $1,700 an ounce gold, and instead of $1,600 or $1,500 or $1,400, like a lot of these other companies with higher margin projects have done. So these companies are really on the sale rack. So if you believe, like I believe, that the gold price is going to be $4,000, by 2025, it wouldn't behoove you to put a little bit of your capital into some of these optionality plays, right? Because I've stayed away from these drill plays that haven't defined a resource for a little over a year now. Because then what's the point? You got all these companies that have discovered multi-millions of ounces in top tier jurisdictions that are trading for less than $40 an ounce in the ground. So I'm gonna invest in those instead, because at the top, in the last major top in 2010, 2011, gold companies were buying juniors at $1,000 an ounce up to $1,000, $1,200 an ounce in the ground. And now these juniors that have multi-million ounce deposits, most of them in safe jurisdictions, even the ones that are in tier 2 jurisdictions that are getting $10, $20 an ounce in the ground, they're trading at significantly less than that. The average is about $40 an ounce in the ground right now, what these companies are trading for. And if that happens again, if majors start to buy out companies at near the blow off phase, at anywhere between $800 to $1,200 an ounce on the ground, you do the math. That's 10 bagger potential on a lot of these stocks.
Do you think like a Seabridge or the Donlin project in Alaska or International Tower Hill Mines, those optionality plays, are they actually going to get built this time up, you think, Dave, or are they just going to be a good stock to trade?
That's funny. International Tower Hill was one of the companies that's interesting you bring up International Tower Hill, because that was one of the stocks back in 2010 that didn't get bought out, that had all those multi-millions of ounces in the ground. But I would at this point right now, it makes more sense to me to concentrate on the higher margin projects because they're so cheap. Sure, add a couple, and I've done so, of these optionality companies, but don't load up on those. Just have a couple just in case, because, in your basket of juniors, and my basket of 22 now that I've accumulated for myself and my subscribers, all it takes is one or two of them to go up tenfold, and you're doing really well, even if the others just keep track with the market. They don't bifurcate as much. So, in 2008, that happened with me with First Majestic and Silver Wheaton. Those are two companies I got in near the bottom in 2008 at the spike low, and I just held them, and both went up over 25 times. So I had other companies that didn't do nearly as well, but I did quite well because of those two stocks. So it doesn't take very many. When you accumulate at a major significant bottom, and when the gold price begins to outperform the stock market, when it gets over that 50% threshold, that's only happened twice in the past 50 years. The first time it happened in the early 70s when I was a kid, taking silver coinage out of my father's my father's change. That's when the gold price began to outperform the stock market. And the next time it happened was back in the early 2000s, and I was able to capitalize on it that time. And hopefully, if I'm right, I'm set myself up and my subscribers to capitalize on it again if it happens again here.
David's website again is juniorminerjunkiewithay.com. It's a free weekly article that David writes about the precious metals and the junior mining sector that you can get emailed to you every Friday afternoon or evening. Dave, always appreciate your insights. Thanks for the monthly check-in.
Always great talking to you. Thanks again for having me on.